Yes, yes. So maybe we can begin now. Welcome everybody to the fifth Finance from the Inside webinar. So today, with my co-guest Vanessa Thomas, with the event project manager of ESSEC, and Franck Herbeau, with the managing director of Axians and lecturer at ESSEC. And myself, we are very happy, we are delighted to welcome our three guest speakers from Activa Capital, Christophe Parier, managing partner, David Quatrepoint, partner, and Valentine Loyer, associate. So I think that Christophe is going to take the floor first. So Christophe, thank you for being with us today, and I let you present your private equity company.
Thank you very much, Veronique. Well, yeah, very happy to be with you today. A small journey throughout, so a brief presentation of Activa, and then jump into our topic of the day, which is ESG within private equity. So I'm Christophe Parier. Obviously, I'm a managing partner at Activa. I've done my whole journey in the private equity in France and in the UK. I worked for 3i, which is a British fund, then for Royal Bank of Scotland, and joined Activa 20 years ago. So I'm a little bit older than you normally. And then we took over the management company 10 years ago, and we bought it from our founders 7 years ago, which means that, first of all, we are an independent private equity investor here on the French market. We invest in mid-sized, fast-growing companies, mainly in the services sector. And our specialty here is to partner with entrepreneurs, to team up with them in order to support their fast growth, mainly through acquisitions. We have 400 million euros under management, which means that we are positioned in what is called the lower mid-market here in France. We are a country fund. That is, we primarily invest in French targets, although we do build-ups outside France. We've done build-ups in the US, in Southeast Asia, everywhere in Europe, obviously, in Africa, and so on. Typically, our DNA derives from our investors. So our LPs are the blue chip partners of the private equity industry here in Europe. Mainly EIF, so a European investment fund outside France, a group of very wealthy families who trust Activa and who have invested money in the funds. And here in France, we mainly have a Caisse de dépôt et consignation, the majority of the French banks, and the majority of the French insurers. So here we are. Interestingly enough for you today is that Activa has been pioneering ESG within the private equity industry in France, as there has been initially in 2008, 6 funds which defined what could be ESG practices in the private equity industry, and Activa was one of these funds. On passe, David.
So, hi everybody, my name is David. I'm a partner at Activa Capital. I'm 26 years old, and I've been in the firm since 2014. And prior to that, I was working as an analyst in investment banking for a US firm called Lincoln International. So basically on this slide, just for you to give you an example, France Invest is a professional organization in private equity, bringing together nearly 400 French management companies. And do not try to read what is underneath each chairman's profile. Obviously, everything is available online if you wanted to take a look. This is just to give you the pearls of how the private equity as an industry evolves throughout the years to incorporate ESG consideration into their business model. So since 2008, Christophe mentioned it, the integration of ESG criteria has become increasingly important in the private equity sector. And this shift is partly due to a growing awareness of the risk and opportunities associated with ESG factors, as well as a growing demand from investors, employees, and limited partners, which are our investors, for more sustainable and responsible corporate behaviors. So proactive private equity firms such as Activa have started incorporating sustainability and social responsibility into their investment and operational practices somewhere between 2012 and 2014, basically, recognizing that ESG is not just good practice, but is becoming a critical element in differentiating yourself from competitors. And to give you an example, in 2021, a PwC survey showed that 65% of private equity firms had developed a responsible investment policy, and 72% of them systematically examined the ESG risks and opportunities of target companies prior to acquisition. And this survey just did not exist in 2010, for example, and for a very good reason, because the answer would have been close to 0%. So today, when we are in 2024, integrating ESG criteria into investment decisions and portfolio monitoring has become absolutely mandatory for several reasons. So the first one is to enable the proactive management of ESG-related risks that can impact the financial performance of your investments, and more on that later on the presentation. On the other hand, it paves the way for investment opportunities that contribute to a more sustainable and inclusive economy. And then going forward, integrating ESG meets the growing expectations of all stakeholders, and especially the LPs, for increased transparency and accountability. And this links to the regulatory framework for ESG, which is a nightmare to understand, but is becoming increasingly important. You can go on the next slide, please. So this slide shows the evolution of our commitment at Activa Capital to sustainable investment since 2009. Christophe mentioned that we were the co-founder of the France Invest Sustainable Development Club with 4 other PE firms in 2009, which was at the time quite unusual. So in the early 2010, there were basically no consideration whatsoever for ESG in the global economy and therefore in private equity. So this was viewed as something marginal and far from financial returns expectations, but the history proved us right with how ESG is considered as of today. So since then, a lot of initiatives were launched. First, the Principles for Responsible Investment in 2010, which is a framework from the United Nations to implement guiding principles into investment practices for PE players. The EC20 initiative, which was the voluntary pledge from PE players to unite and take action for their contribution in the COP21, basically. We developed an ESG committee, which basically runs exactly as an investment committee. So this was a big change for us, and so on. So I'm not going to go through each of these, but as per the previous slide, it's just to show you how we grow as a management company an ESG practice over the years to tackle ESG considerations. On this slide, we wanted to present to you in the same idea, how private equity evolved throughout the years. And starting on the left, you have traditional investing, which is a practice that does not exist as of today. But, and so I'm going to go through each terms just to give you a flavor on how ESG is incorporated further and further deep into the business model of private equity players. So traditional investing, for instance, is primarily focused on financial returns without explicitly considering ESG factors. So the main objective was to maximize financial gain for investors. And to be clear, this type of private equity has totally disappeared as of today. So it would be impossible for a management company to raise capital and be compliant with the current regulation with that kind of pledge. Then you have responsible investing, which involves incorporating ESG factors into investment decisions, right? So this approach goes beyond financial analysis and includes considering the ESG impacts of investments. And it can involve strategies like ESG incorporation, where ESG issues are explicitly included into investment analysis and decision. and really active ownership from a PE point of view, where investors engage with companies to improve their ESG performance. Then you have sustainable investing, which is often assimilated to responsible investing, but actually it goes a step further because it deeply focuses on investing in sustainable companies or projects that aim to generate long-term social and environmental benefits alongside financial returns. So it is grounded in the idea that you can create long-term value, including ESG factors, which was not the case for responsible investing. And then you have impact investing. And impact investing, the difference is that it's about being intentional about generating positive, measurable social and environmental impacts alongside financial returns. So the huge difference is being explicit. You know, you have to make a pledge, you have to go public on your decision, you have to go public on the data you measure, and you have to go public on how, as a private equity players, you impact positively a business model or a sector or a company. So this raises the question of how you can measure the impact. And when it comes to measuring impact, there's a lot of different approaches with their own set of metrics and methodologies. And this is, again, something very new for PE players and for the overall economy and the industry. So this is a moving stage. So traditional investing mainly focuses on financial metrics. Responsible and sustainable investing also consider ESG performance indicators, but basic indicators. And then you have impact investing. You have to set specific measurable impact targets, and there's no recognized methodology to date. And most of impact investors develop their own proprietary methodology to measure their impact performance. And so we will come back to the measure of performance of ESG initiatives in private equity later. But again, this is something very new, and there's no shared framework as of today. You can go on the next slide. So the regulatory framework for these investment approaches is constantly evolving, and it's really hard to follow and understand. So I'm not an expert on this, to be clear, but I just wanted to give you 3 key concepts for private equity players as of today that need to be understood. So just to zoom on these 3 important frameworks, they are interconnected. So they work together to create a consistent and efficient system for sustainable finance in the EU. And the aim, the final goal for this framework is to direct investments towards sustainable activities and support comparability and transparency between financial investors and financial investees. So the first one on the bottom left is the CSRD, so Corporate Sustainable Reporting Directive, and it aims to standardize ESG disclosure to reduce information gaps. So it's just points out to make it easier for stakeholders to assess companies' sustainability performance. The EU taxonomy, it's a classification system which defines which economic activities can be considered sustainable. So you have a criteria, a common language for all economic activities in Europe across different sectors and industries. And then on the far bottom right, the SFDR, it's just for financial players such as private equity firms. And the focus here is on transparency on the financial market for every participant to disclose how their products align with ESG factors in the taxonomy. So basically, it's just to prevent greenwashing for financial products and ensure investors that they have the necessary information to make sustainable investment decisions. So let me summarize very briefly. So the CSRD provides the detailed reporting standards for companies. The taxonomy offers the classification system for sustainable activities. And then the SFDR ensures that financial products, such as private equity, are transparent about their sustainability claims, leveraging the information that you have in taxonomy and CSRD.
Thank you. Thank you, David. So, hi everyone, just to introduce myself, I'm Valentine Lawyer. I'm an investment associate at Activa Capital, which I've joined a year ago. Before that, I started my career at ESSEC, which is another investment fund focused in tech, and I'm a graduate student from ESSEC 2021 from Necon École. So now we're going to talk about, like, in practice, how do we, as a PE fund, incorporate ESG across the investment cycle. So it basically involves a very structured approach across 4 key different stages. First one being the due diligence, in which you need to assess for risk and opportunities on the companies that we're currently looking at. Value creation plan, you will find at the value creation plan, the creation plan creation, that you need to incorporate ESG KPIs to follow and make sure that you develop and create value, will be environmental for people. On the holding and monitoring stage, you will then assess those KPIs and ensure that as a board, you monitor and you improve on those KPIs. And at the exit stage, you deeply review them and try to highlight the areas in which you've made some improvements. And this is what's going to be quite hard as a PE fund, but you will want to highlight the areas in which the improvements on ESG criteria have created some value. So all these criteria are that have to be monitored by the investment team, sometimes with the help of external advisors on some specific areas, for instance, cybersecurity or social and corporate development. Now, if we talk about the first phase of the investment process, so at this initial stage, we apply a very strict exclusion policy, which is consistent with our DNA, ethics, as well as our commitments to our LPs. It's the investment team responsibility to assess the ESG risks and opportunities. In practice, Activa and other investment funds will not invest in companies which would not respect international standards, such as the UN Global Compact Principles, the OECD, or the ILO. And besides, as an investment team, we are committed not to invest in sectors or activities that can harm or the planet or cause an increase in greenhouse gas generation. We've put down below some exclusion policy areas. For instance, correlated activities, pornography, alcohol. It's not exhaustive. There are other sectors, but yes, these are the sectors and activity in which we would definitely not invest. If the company qualifies, and we are able to look at it, we would then look into more details into the specifics of the business model, and would cover ESG issues such as environmental, social, governance. And as we specialize on services companies, as said Christophe, the people criteria will be the most important that we typically cover, to make sure that there's a well-being culture in the company, there's not a high churn of people, etc. So after we made that analysis, as the investment team, we provide our conclusions in what we call the investment memorandum. So same as the typical investment memo you would find in funds, this one is dedicated to ESG analysis, and we would review it with the investment committee prior to invest in the company. At this stage, we typically make a list of some potential areas for improvement and how we're going to tackle them in this value creation plan that I mentioned before. And we sometimes have hire external consultants to help us improve on those criteria.
Maybe just to give you an example before jumping into the value creation plan, because if you can go back on the previous slide, sometimes it's pretty straightforward, because when you just look at the exclusions that we have in our LPA, it's basically just a go/no-go decision that's easy to make. But sometimes, we have a case study, a recent case study that can illustrate that sometimes it's a bit hard to do this. So it was with Frank, actually, 2 or 3 years ago, maybe something like that. Yeah, we were looking at an investment opportunity for a SaaS software company developed by a geologist that was capable of seismic interpretation. And a very nice company with very strong fundamentals and very good figures, good growth, good profitability, and a business model that private equity is actually fond of because you have a strong retention rate and so on. So the problem was that 100% of its customer base was made up of oil and gas companies that used the solution exclusively to detect oil and gas pockets. So from there, our analysis changes because if you just look at the business, it's a SaaS software and it can do a lot of things. But in the end, the use case of every customer is for exploration, petrol exploration. So from there, the analysis changes and the business plan we had was really consistent. There were good returns on investment at stake. But however, our central question was whether this company would be sellable in 5 years. Yes, but probably not to a private equity player because ESG constraints on the transition in 5 years will be such that their management mandate will no longer allow them to invest in that type of company, first thing. Could the company be sold to an oil and gas company? Probably yes, but we didn't want to realize capital gain on the controversial sector. And now the tricky part of the reasoning was when you look at oil and gas players, their weight in the climate issue, they are by definition actors for the energy transitions. And that's a fact. So in our view, we asked ourselves if there was a possible business plan to make the transition and to change the use of the platform among these oil and gas companies to do carbon capture and not oil and gas exploration. That was being able to sell a completely different equity story in 5 years with a lot of value creation potential in the end. But we finally declined the opportunity because it was far too risky at that stage for the company, and it required too much investment for an LBO to make such business plans. So it is just to give you an example of how sometimes the indirect exposure of a management of a company can be quite tricky. So if you go back to the value creation plan, maybe, yeah. So you are post-closing, right? So once you have made the investment, there's significant push to make as a financial sponsor to deliver the value creation roadmap that we had. It is true on finance, it's true on management, organic growth, external growth, and it is true as well for ESG. So for every value creation pillar that we have in what we call in our industry the equity story, you want to be in a position to accelerate rapidly after closing of the operation. So what we systematically do at Activa is to take time with a third-party advisor to identify the most relevant and material issues to be addressed and explore the most appropriate levels to build a robust ESG policy and business model for the company. So we set out every criteria, every objective that have to be met with a calendar and a responsible for actions. So maybe a quick examples for this. So for a recent portfolio company that we made 1 year ago, we had, after the value creation plan, we had more than 100 KPIs that we wanted to implement for the company. So regarding governance, you had to recruit a head of quality. You have to build a satisfactory customer review, formalize a GDPR policy, create a data protection department, invest in cybersecurity, invest for training for the COMEX on sustainability and climate change, etc. Regarding social and employees, we had include ESG factor in annual review, invest in training, build a career path to retain talents, extend maternity and paternity leave, pro bono actions, and so on. For the environment, we had reduced mobility, obviously, create awards for eco-responsible employees, rethink the IT organization to implement eco-conception for the software, measure and reduce the carbon footprint, and so on. So the roadmap is you have a lot on your plate. You have more than 100 KPIs that need to be addressed, and it is a long-term creation plan. So once the roadmap is clear, our job as a private equity investor is just to monitor the implementation on a regular basis and foster a positive mindset around these initiatives. So our job in the end is to make our CEOs deeply believe that it will create value in the midterm, and to give them the tool to convince and drive their employees with the same mindset. So, no, tu peux revenir, Olivier? Yeah. So during the monitoring phase, I just mentioned a little bit of this, but the monitoring phase is just good governance and project management, like for any other project. So you want to be sure that the objective is clear, that the targets sets are reasonable and achievable, and that adequate resources are provided. So human force, obviously, but also money. So you can't expect a company to implement a robust ESG policy if you don't give the necessary resources, because it can be quite overwhelming. And to do so, the new issue of the day is the data, because the data gathering is also to be considered, because whether it comes from the regulations, the GPs, the LPs, the data points that you have to build can be overwhelming. So it may make sense at some point when you have, let's say, a 50-60 million revenues companies in the portfolio, to dedicate a specific budget to organize your data around ESG. So at Activa, we have a monthly reporting, a quarterly review during advisory boards where we monitor the implementation of the roadmap. And obviously once a year, we have the budget preparation, where ESG is one of the pillars we set objectives on, as much as financial returns. Then you can go on the next slide, please. And something that is particular with the private equity industry is that when you put a business on sale, the usual way to do this is to, well, you have an investment bank, you have vendor due diligence on finance, on strategy, and so on. But now we have, as value creation comes also from ESG, whenever possible, we try to gather our value creation regarding ESG matters in a dedicated vendor due diligence, always realized by the third party, starting from Activa's entries up until the exit when we put the business on sale, just to monitor how important was the change of the company during the 4 or 5 year holding period. And we have done that as early as 2020 for a company called Citycat you have on the right, for the exit of this label printing business. That's pretty much it on this slide. If you can go, then yeah. So I put on this slide just a few questions that you probably have now, and before the actual Q&A session starts. First is about the role of a PE sponsor regarding portfolio monitoring. So as a financial sponsor, regardless of majority or minority shareholder, you want to be careful about how much you weight in a portfolio management decisions. You know, it's not a mandate to impose something to the CEO. So you cannot interfere and impose strategic decision to your management team if they have a different vision, especially for us at Activa, because we invest only in founder or entrepreneurs-led businesses where you are supposed to be a very positive partner, and you invest in the management team, so you have to align the vision. So the question is, what can you do to foster ESG initiatives when the owner of the business is not fully aligned with your vision? And I believe that our role as a financial sponsor for the CEO is to educate the leaders of the company on ESG. So why climate change is important, how and why it will impact your operations someday, why you have to be a role model to your employee if you want to have a sustainable business and continue to attract new talents. So before any KPIs, any reporting and so on, the most important impact we will have as a PE player cannot be reported, and it is the switch in the mindset for the CEOs. In the same way, the second question is, what are the key selling points as a PE talking to a CEO and a co-shareholder to foster a new mindset targeted at ESG? This is just a few examples. There's a lot more, and it actually depends on the CEO and on the business. But First is from a risk management perspective. How do you convince a CEO? Well, you have to have the discussion with the CEO about your business will not sustain in a world with +2 degrees. How do you adapt? Your business is at risk because you have, let's say, infrastructure in a dangerous zone. Your business is at risk because you are not compliant with GDPR, and the data you sell is subject to regulation, and that could be a really strong issue in the coming months, etc., etc. From a risk management perspective, it always works because it questions the business model of the CEO. Second is from customers. So you have to have discussion with your CEO about the customers. So they will not continue working for you or with you if you do not demonstrate your climate plan, let's say. They will not sign the contract if you do not show responsible supplier charter and so on. And this is actual use case that we have in the portfolio as of today. So when you are a small company, an SME in France, and that you want to work with LVMH or you want to work with BNP and so on, you have to demonstrate something around ESG, which was not the case a few years back. And the third one is around brand image and reputation. So the discussion with your CEO will go through, you will not be able to recruit and retain talent if you do not have a comprehensive sustainable initiatives towards employees. You can have the discussion around what is good for your employees, is good for your company, and therefore is good for financial returns. And as students for you today, I highly doubt that you will go work tomorrow for a firm who does not offer you a clear career path, who does not motivate you with other incentives than financial incentives, and for a firm who is very skeptical or cynical about climate change, for example. But most newcomers on the market as of today ask the question during interview, what is your view towards climate change? And if you do not answer that, or if you don't have a satisfactory answer with that, you will not recruit. And that's a fact, and that's something that we can monitor across all our portfolio companies. Last one is for the shareholders, obviously. So this is the discussion that I mentioned before with the use case of the company that we looked at. Is the discussion around you will not sell your business if you do not have a robust ESG department. So the business is good financially speaking, but it's illiquid because you don't have an ESG policy and you cannot demonstrate how sustainable your business is for the coming years. So you can't be valued as much as if you would have implemented a robust ESG policy. A question between reporting and impact. So beyond reporting, what is the actual impact of ESG initiatives? So if ESG only relates to reporting numbers without any consequences, if those numbers do not improve, it does not make any sense. So that is true, but it's the starting point, you know, and it's a need that you have to be transparent about this data. And before improving data, you have to monitor it and report it. So very few PE players as of today engage themselves publicly in improving their ESG performance year on year, but it will come in the next 2 years. But since 2023, more initiatives are out and information are shared by PE companies from PE companies one to another, relating to how they intend to get better and to reach a medium-term target. So now that you can go on every private equity player's website, download the ESG annual report. And for most players, you will see the targets that are set for the coming years. And you will see reporting being much more intelligent than it was 2 or 3 years back. A question on how ESG initiatives create financial value. So that's the most tricky question, obviously, but the probable answer is yes, because it makes your investment much more liquid, which in private equity is absolutely key. So can it be measured? Today, probably not. And it's difficult to be measured between the OPEX and CAPEX necessary throughout the investment cycle up until exit, and the difference of price you would have been paid if these were not implemented. So it's just not possible to compare the two situations. First, we lack data points because, again, the reporting and the regulatory framework is very, very, very recent. But the second is to question the difference of financial value created by non-financial value initiatives. We only have one option, and is to answer the what if question. So it's called the theory of change. And the question is, what would have been the value of my company if I didn't have implemented a sustainable policy? The answer is probably less value, but I can't measure it and I can't compare the scenarios because I made the choice to implement an ESG policy. Therefore, my business developed in a particular way, and all other ways are just hypothetical to date. So no one can measure that. It can be pretty obvious as a statement, but a lot of professionals as of today are working on a framework on the theory of change to measure ESG value creation. And a quick remark on greenwashing. To date, to my knowledge, there are 0 PE fund that was pointed out for greenwashing. There were a few funds classified as impact funds under the SFDR that were declassified as Article 8 funds, which are responsible investing players. But this is due to the moving stages of the regulatory bodies. So everything is under test right now, as I mentioned, and it changes very, very fast. The regulation from the EU is increasingly complex. So some PE players may do ESG in a cynical way, but in the end, only the results matter, you know. So of course, doing it in a cynical way will be less effective than doing it with a strong conviction. And in the end, I think that it will make the difference in performance, in brand image, in talent retention, and so on. So when I speak for Activa, and we are in a very competitive environment. There's a lot of PE players out there. I mentioned 400 in France. So ESG also offers strategic opportunities to differentiate yourself from the competitors. And that's pretty much it for me. I don't know if Véronique, Franck, you want to conclude or...
Yeah, maybe.
Start the Q&A.
Well, thanks a lot, David, Valentine, and Christophe for this very nice presentation. Just I want to come back to what you said about the investment we looked at a couple of years ago. And I was really impressed, and you were just talking about greenwashing, but the company was really purely exceptional. It was considered that by most of the big oil companies as having a technology that was unique and extremely helpful. And it also had a potential major role to play in the development of one of the key future technology for the control of climate change, which is carbon storage and capture. But you consider that was not enough. And also all the other things were more than green. I mean, the management team was exceptional. It was a purely international company with an extremely good product, a very good business model. You decided not to go because it was not enough. So, I mean that what you are doing is not is to take a real look at ESG, and I would not say that it's just a greenwashing, and that you use ESG as a marketing tool because you missed a very nice business opportunity due to your ESG involvement. So that's one. What I wanted to discuss with you is that one of your particularity or one of your specificity is also your size. So very often you are a primary LBO or secondary early LBO. Do you see a change in perception? And when mid-sized companies start with LBO, they have a huge amount of reporting, financial reporting, business reporting to do, which is complicated for you probably to manage. You add to that ESG. It's probably painful for the managers when they start. After a few years, do you see a change in perception, and what do the CEOs you work with think about the ESG policies that you enforce to them after a couple of years? Do they think that it was just painful or also useless? What is the feedback?
It was from my perspective really difficult in the early days in 2017-16 when you out of nowhere send an ESG reporting to your CEOs. They never heard that before. There were no education around that, so it was really painful to just get the data, because the data was not ready available as the financial metrics, because you follow them since forever. So ESG data was really hard to find, really hard to measure, and it was for small companies, when you do not have infinite resources to put on such a subject. That was for the CEO and the CFO to invest a lot of time to gather the data and to defend it. So this was really difficult back then. Now the frameworks are more standardized than ever. So you have run reporting for every LPs that basically answer all the questions that may arise. So before that, we would send out 10 different reportings, maybe asking 100 times the same questions. So now we have formalized one reporting, and it's by the industry. So every PE players have the same thing. So that helped a lot. Second thing is that the first time you answer the same questionnaire is more easy. The third time, fourth time, fifth time, and now we are in the 5th or 6th years of ESG reporting, so it's much more easier now. And the final answer is that as we grow, CEO as of today, when we make a primary operation with 40 euros, let's say 40 founder-led entrepreneurs business, they are more convinced and more aware of the situation than the CEOs 10 years ago. That's a fact. Yeah.
Thank you.
Has anyone a question in the audience? I've not seen anything in the chat. Otherwise, I can ask some questions. My first questions were relating to the cyber security, because I saw it was in your criteria at the beginning, the first slides. So owing to what happens, what happened quite recently in France, it's something which is more and more important. So do you have you seen a lot of issues on this aspect, which is related to data?
Sorry, can you ask the question again?
Yes, I wanted to ask you if you had seen some significant issues related to data and cybersecurity, considering what we saw recently in France, for instance.
Yeah, je commence, David?
Ouais,
Well, yes, of course. Well, even in mid-sized companies and the companies we are partnering with, they're daily attacked, cyber attacked. And for instance, we have a business called Ingeliance. It's an outsourced engineering business working mainly for the French defense. And they are attacked, I would say, between 100 and 1,000 times a day. So it's totally critical. In another business, it's a software business called Arch. And it's a business, it's an ERP operating the people. It's a home care software, so it operates the people going to elderly people's home. We have been attacked, we think, by a Russian cyber attacker. It was 2 years ago. And we own critical and very sensitive data about all these people, as you can imagine. So the level of attack and the level of awareness has grown a lot. And as a consequence, as a shareholder and as a partner, yes, we are equipping every businesses we are partnering with cyber attack defense programs nowadays, which is totally, of course, in line with ESG processes.
Thank you. I had another question relating to ESG in the companies you supervise, you focus on. Have you the same importance which is given to the three, or have you seen that one of the three aspects was more important, or
Very good
Well,
question.
that depends on it's not the same answer for every private equity players, because at Activa Capital we only invest in innovative business services, right? So it's usually asset light. So we have not real environmental concern from an asset point of view. On the other hand, business services means people-intensive businesses. So we have a lot on our plate when it comes to governance and social matters, and we strongly focus on these two areas. But if you are a private equity player, which is a generalist player, and you have a part of your portfolio with capital goods, industry or services or products, then probably the environmental will take the lead on the three pillar.
And maybe you could add something on the value sharing, David.
Since 2019, there's something called Loi Pacte in the finance law that is in place, which allows for private equity players to give back for all employees part of the value created as a shareholder. So it was an important dispositive because you have such mechanism for the CEOs, for the management team, for the C-level, but you do not have this kind of mechanism, or it will be increasingly complex to pay back some of the money that you made during a LBO to every employee, regardless of who they are in the period. And so since 2019, it is possible in France, and we were among the first, maybe the first private equity firm to do it in 2021 for one of our portfolio company, and we decided to give back roughly 2% of the financial capital gain that we will make on a portfolio company for 450 employees. So this kind of mechanism, they are really inclusive because they consider every employee as a shareholder. So this is something that is feasible now in France, and that we are proud to implement in every portfolio company.
I have two other questions, unless somebody else has a question. I just don't see in the chat. First question relates to the management of your private equity company. Before you had this importance of ESG, I mean, some years ago, you were not compelled to focus on ESG as much. So have you tried to see, or maybe you consider separately the time and the monies that you spend for ESG aspect in your global approach of company?
I'm not sure I understood the question, sorry.
Can you be a little bit more specific?
Yes, it means that I think, let's say 20 years ago, we did not care about ESG as much as now. Of course, you have a lot of regulations, so you spend a lot of time. You need to have teams who work on that, etc. So do you consider the portion on ESG as significant in the whole package?
Yes, I can answer that because I'm at Activa, I'm in charge of ESG for the investment team. So,
and you're very expensive.
Yes, okay.
So I would say that
Well, it was a joke, of course.
I would say that, yeah, in 2015 or 16, there was maybe 2% of my time. Now it can represent up to 10-15% of my time, maybe.
Okay, so that's quite significant.
Yeah.
And I have a last question relating to other European countries. So how are we positioned in comparison with other European countries? Some of them being considered as more sustainable as we are. So could you tell us about that?
Yeah, well, there is a clear and loud answer on this one. Astonishingly, France has been a pioneer for private equity in ESG. by everywhere you're looking at the subject. So, and France Invest is really ahead in the game. So when compared to the US, obviously that's sure, and when compared to other countries, it's the same because the movement here has begun, yes, so just before 2010, and so there has been a sort of an advance taken by French players. And so today, big French funds, Paribas Affaires Industrielles, Astorg, Ardian is definitely the world leader in ESG practice within private equity, and is a sort of opinion leader on that.
We have, Véronique, maybe some questions from the audience that I see in the chat. So
Yes.
I can maybe take the lead on that. So first one from Francisco. What are the main topics academia can research to help fulfilling some of the data and concept testing missing, as shown in the last slide? To me, personally speaking, where we lack intelligence to date is really the non-financial initiative. How can you measure that with non-financial measures create financial value? There are a lot of different approaches, a lot of different methodologies, but to be quite frank, that there's nothing to date that has been pointed out as the one and only methodology to do so. So you have to put effort on the research to make this gap, because the actual question is, does ESG create value? We all say yes. The illiquidity part is very important, but it's an indirect answer. So how can you measure it? How can you put numbers on something which is not a number? And you can look at, for instance, Institut de la Finance Durable. They've put out a methodology that is really interesting, but it needs to go further. And furthermore, it needs to be challenged by professionals. It needs to be reviewed by and tested for 1 year, 2 years, 3 years to see if this is something that can be put in place at a larger scale. So from my point of view, being able to come up with a methodology to measure this is probably the biggest challenge for private equity players, because as of today, impact investors, they all have their proprietary methodology. And it doesn't mean anything because it's not public. So I can say that my investments are great from that point of view, but it cannot be challenged. It's not open source. It cannot be challenged. You cannot have access to the numbers. So once a private equity firm comes up with a proprietary methodology that can go public, can be challenged, yes, the system will get better. Second question from Leon. How long is your typical investment period? So we are an LBO company, so roughly 4 to 6 years. And obviously there are some mitigants, though the most rapid one was 2 years and the longer one was 10 years. You don't really have, as a private equity player, the obligation to sell an asset. Even though your PE fund only lasts 12 years, there are always legal ways to recycle an asset within a fund. So as much time as needed to put out the value creation plan. And for the question on short-term financial returns, traditionally in private equity, we say that we need a business plan on 10 years, even though we sell at 5, because you can have a great trajectory for 5 years. If the 5 coming years you are flat, you will not sell your business, you will not demonstrate something, and you will not sell your business. So short-term profitability, yes, obviously, because when you took a larger scale, 5 years is not that much, but it's the most long period for every asset manager. So private equity is the most robust investment in that perspective. But then you have to show to your buyer as a vendor that you have still 5 years of sustainable growth going forward. So as a private equity investor, we always ask the question for our CEO to how can you make your business more sustainable for the coming years? How can you make a good sustainable trajectory so that you can sell your business in 5 years. And yes, you have to come up with business plan, sometimes business model change to make your business sustainable in 10 years. That's how we reconcile the two. The question from Tracy, the current challenges you face in incorporating ESG in your firm strategy. If you speak about Activa Capital within Activa Capital, when we are lucky enough to be independent, so we have 4 partners holding 100% of the companies. And as you see, Christophe was among the first to push initiatives for our industry and at Activa Capital. So inside Activa Capital, everybody is pretty much convinced that it is the good way going forward. So there are not many, how do you say, that prevent us from implementing a good ESG strategy. So I'm responsible for ESG considerations within Activa Capital, and basically once a year I make my own objective and make my own budget, and we challenge it with our third-party committee, ESG committee, and we try to be every year beyond compliance. So compliance is done. It's done for so many years now at Activa Capital that we don't pretty much look at it anymore. But we want to be, for our size, because we are a $400 million euros company. It's not that much in a private equity space. We are a small player. We want to be at the forefront of what ESG can be in the next years. And to do that, we have the full support of all the partners. And I think that's pretty much it.
I don't see any other question in the chat, so maybe we're going to conclude now. So we would like to thank Christophe, David, and Valentine for being with us today. Your presentation was very, very interesting. I have a lot of questions, but I think maybe by email I can send them to you. We also thank all the participants for being with us today. So thank you, everybody, and have a nice day.
Thank you. Bye-bye.
Merci.
Thanks a lot.
Bye.